Warren Buffett says that every person wants to do a little gambling. And I wanted to teach this important thing to my children too. That's why 40 years ago I bought a slot machine for my kids and put it on the third floor of his house. And that whenever I used to ask my children to do some work, they used to ask me for money. Now whenever the children asked me for money, I would give them that money and get my work done. Then my children would take money from me and go to the third floor and gamble by putting this money in those slot machines, and I would go back at night to withdraw that money and get them to work again the next day, and I would give the same money to them. And it goes on. So the question in the mind of many of us would be whether to be a trader or an investor. Both the people buy and sell the shares. Only the difference of time is there. One sells early and one sells it after a while. So the best way to understand the core difference between traders and investors is to understand the PE behind it. We can understand this by taking the bank's example in a very easy and interesting way. See, if you invest money in the bank today and if the bank gives us 10% rate of interest, then after 1 year that money will become 110. Now out of this 110, 100 was yours. That is, what happened to your earning was 110-100 is equal to 10, so we can understand this thing in such a way that for earning 10 in a year, we paid 100 price. That is, in this case the price is 100 and the earning is 10, so if we calculate the PE ratio, then it will come that price divided by earning, which is equal to 10. Now the question is that this has come to PE 10, but what does it mean? This means, to earn 1 in a year we have to pay 10. That is, a 10 note will give us 1. Next 10 note will give us 1 more, and another 10 note will give us 1 more. And so on. There are 10 notes of 10 in 100, and each 10 rupee note earned us 1 in a year. Now we can look at this equation in another way also. If we multiply the denominator on the other side, then it will become price is equal to PE in earnings. Now the most interesting thing is that as long as the interest rate of the bank remains the same, its PE will also be the same. But this is not the case in the case of the company. His PE is always changing. For example, if we go to Screener.in and open the company of Asian Paints and see the chart of PE, then it keeps going up and down every day. So the most difficult question is, the bank's PE 10 remained the same for the whole year, but why the company's PE is changing every day? Whereas we get to know the earnings of the company after 3 months. When quarterly report comes about his 3 months. Why so? So again, look at this equation. The share price of the company is made up of 2 things. First, its actual earnings, that is how much money the company earned in actual, and secondly, what was the emotion of PE, that is short of public. Now some people call PE as emotion. Many Mr. Market speak and many say that the public is being optimistic or pessimistic. If we talk about the company PE, then it represents the emotions, and that is the main difference between an investor and a trader. An investor is always focusing on the earnings of the company, that how will the earnings of the company grow? How will the company expand to new places going forward? How to bring new customers, that is, the investor always focuses on the business, but a trader does not have much to do with the earnings of the company. His main focus is what is going on in the news related to the company, so that he can know the emotions of other traders, so that it can be known whether the price of the share will increase or not, and buy the call or put option corresponding to it. So first of all, our learning is that the main focus of a value investor is on the earnings, but the main focus of a trader is on the overall market mood or on any news which will make the price higher or lower. Next point says that investors also see PE and traders can earn. This point means that investors also look at the PE, that is the mood of the market, and traders also look at the earnings of the company. Now many of you must be thinking that what is this? It will be the reverse of the previous point. So let's understand it in simple language. Again, we look at the same equation, that the price of a company's stock is made up of the earnings of its shares and its PE. Now let's see that both you and your friend are value investors, and both are analyzing a company named ABC PVT Limited. Earnings of 1 share of this company is Rs.100. You both did analyze this company and came to this conclusion, that the earnings of this company will double in 2 years. That is, the share of 100 rupees will increase from the share to 200, and both of you think of buying the shares of this company. You buy this company when people are thinking negatively about it. because of which his PE is low and he is running 10. And your friend is a little late. So at that time the PE of this company becomes 20, then it comes. Very interesting thing, and that is, both you and your friend did the fundamental analysis of this company and then bought the shares of the company when its earning was 100 rupees. But you bought the shares when its PE was 10. That is, the price of your one share was 100 into 10 is equal 1,000 rupees. But unfortunately your friend had bought the shares of the company when the rest of the people got excited about the company, due to which its PE became 20. That is, he had bought the same shares with the same company fundamentals, 100 into 20 for 2,000 rupees. Now in 2 years, the share price increases and decreases as well. But you know that the fundamentals of the company are strong. So both of you do not sell the shares of that company, but 2 years have been completed. On the earnings of the company, the share has increased from Rs 100 to Rs 200 and the PE is 20. You both sell the shares in this situation. Because both of you feel that the management of this company has changed and you do not trust the new management, because earlier they had done a lot of scams. So both of you sell each share according to 200 into 20 is equal to 4,000. Now let's see the returns of both of you. You had bought each share of 100 rupees and now it has become 4,000 rupees. But your friend had taken each share of 200 and that too for 4,000. That is, you have 4x return while your friend has 2x return. This means that the PE also exceeded your return by 2 times that of your friend. If you and your friend had invested 10 lakh in this company, it would have become 40 lakh but your friend's 20 lakh. And this is the reason why an investor focuses totally on earning, but use the PE to his advantage. That is, if the PE is low, then it will be preferred to buy the stock. On the other hand, if we talk about the trader, then he also keeps an eye on the earning report of the company. Because he knows that the company had said in the last quarter that it will earn shares Rs 2,000. But in the report of this quarter, if they have earned less than 2,000 rupees per share, then sure people will sell the shares and the price of the shares will be low, and why not manipulate the situation and earn some money from it? The next point says that maximum investor were traders. Many people refer to Rakesh Jhunjhunwala and Vijay Kadia. Both of them also said that invest, do not trade, but these people had done trading in the beginning, which he made more money in less time and then he invested that money in investing. And you're right because maybe 99% of the 100% people lose money in trading, but do you know that you are one of those percent who make real money? So I will give you information from different sources in a few points, which you can listen to and decide for yourself what you have to do. Source 1 is the most famous investor Warren Buffett, who says that trading is gambling. If you win money in one turn, you will get addicted and most likely lose your money in futures.
Day trading, I would say, and very often came very close to gambling as defined.
Source no. Two great investors Vijay Kadia says that in trading there is no guarantee that your money will be 1 to 50 lakhs, but in 2 minutes it can be 1 lakh to 0. Source 3 This is a research paper in which the Brazilian equity fund market has been invited, whose conclusion is that only 1% of traders are able to earn money in actual. Even when Vijay Kadia was asked that you have done the first trading to earn money and now you are refusing others. So in this video we have seen basically 3 regions on the mentality of trader and investor. In the first point, we understood about the PE equation and then saw that the main focus of the investor is on the earnings of the company. It is on the mood of the market, that is on the emotions of the people. In the second point we had taken the example of you and your friend that if you both do the fundamental analysis of the company, and even if you know that the company is going to have a earning increase, yet you earn more money because you bought shares at low PE, so investors prefer to buy shares by looking at the PE so that they get more profit. Traders also see the reports of earnings, but their main reason is to see how earning affects people's emotions and hence can use the emotions generated from earning price prediction. In a few points, we had discussed that many people give this point. Initially we can trade to increase our low capital, and later we will definitely invest, because many investors like Rakesh Jhunjhunwala and Vijay Kadia also did the same. Of course now whatever he says, it is true in actual fact. That's why I put the thoughts of great investors in front of you. Finally, we all have to take our own decision. Anyways, friends, if you do not want to miss such knowledgeable videos, then do not forget to press the bell button after subscribing. You can also comment and tell the next on which topic do you want the video, then let me meet you in the next video. Thank you.